Day 24, your personal return versus the fund's return. Here we are on Christmas Eve. The anticipation is high, and our journey is nearly complete. We have built a system of immense power and simplicity. But today, we must confront a sobering and final truth. There is one variable that stands between the flawless return of the fund and the return you actually experience in your life. That variable is you. For decades, the research firm Dalbar has conducted a quantitative analysis of investor behavior. Their finding is consistent and staggering. The average investor earns a return significantly lower than the return of the very funds they invest in. How is this possible? The fund does its job. The market delivers its long-term return. But investors, through their own behavior, intercept that return and diminish it. This is the critical difference between the fund's return and your personal return. The fund's return is a mathematical fact. Your personal return is determined by your decisions, the decision to buy and, just as importantly, the decision to sell. It is the gap that is created when we allow our emotions to overrule our plan. We see this play out in a destructive cycle. Driven by greed and a fear of missing out, investors pour money into the market after it has already risen significantly, buying high. Then, driven by panic and loss aversion during the inevitable downturn, they sell their holdings, locking in permanent losses and missing the subsequent recovery. They are emotionally buying when the market is greedy and emotionally selling when the market is fearful, doing the exact opposite of what our philosophy teaches. This behavior gap is the final and most formidable adversary. You can own the perfect, low-cost, globally diversified index fund, but if you lack the discipline to hold it through the market cycles, its theoretical return will never be yours. This is why our entire Advent calendar has been as much about psychology as it has been about finance. The system we have built, the automation, the diversification, the long-term perspective, is not just a financial blueprint. It is a behavioral cage designed to protect you from yourself. It is a set of rules that keeps you from making the costly, emotional decisions that plague the average investor. As we stand on the brink of Christmas Day, remember this: your ultimate success is not just about choosing the right investments. It is about choosing the right behavior. The greatest portfolio in the world is useless without the investor who has the fortitude to hold it. Tomorrow, on Christmas Day, we will open our final door and receive the ultimate gift this philosophy offers. Thank you.